Let's bring Richard Flax into the conversation, CIO of Moneyfarm. Richard, great to have you with us this morning. I'd love to kick off with your take on UK assets, because we've seen a huge amount of movement over the last month in the British pound. We've moved from 126 about 30 days ago to above 131 now today. At the same time, the FTSE 100 has been underperforming other markets over the course of the year. No doubt part of that, the strength we've seen in sterling. Do you think that the UK market overall is appropriately reflecting the economic outlook?
So I think it's a challenging environment for UK assets. You can see that, as you say, that the FTSE 100, which has a lot of international exposure, is going to potentially suffer a little bit as sterling strengthens. But the UK market does look relatively cheap compared to its history, at least on our metrics. And so there is obviously a challenging economic environment, but to a large extent that should be reflected more in some of the mid-cap stocks rather than some of the large global stocks that we see in the FTSE 100.
Do you think that the pound's recent rally makes sense, or do you think that it's time to be taking some profit there if you are invested?
I think that the recovery from what we saw in the sort of depths of 2022 makes some sense. There is a little bit more stability, but obviously it's a challenging economic environment. Inflation hasn't come down as quickly as it has elsewhere. The structure of the mortgage market is challenging, at least for a particular cohort of mortgage holders. So there are definitely some challenges in UK assets at the moment.
Richard, if we just take a close-up look at the resources sector, you can see so far it's been mostly a downward print this year. Some of this are reading on the China demand story. Do you think that's going to improve at all in the second half?
I think that there is potential here. Again, you've got this a little bit of a tug of war between the cyclical demand component, where we could expect to see the global economy slowing a little bit as interest rates begin to bite. And so that can impact some of the demand. On the other side, you have the supply question, where we would expect supply to become a bit more challenged. It takes longer to get licenses. There's obviously the transition to net zero puts some pressure on the ability to open new mines, but at the same time, we still need these resources in the interim. So that tug of war is a little bit in play, and to the extent that we do see a softer landing, then potentially we could see some recovery in commodity prices.
So, Richard, in context then, given the challenges across various different sectors of the UK market, how tactical can you be around trading UK stocks at this point?
Again, tactically trading, it wouldn't necessarily be our approach. We think from a long-term perspective, the UK market does look cheap relative to its history. There are clearly some cash generative businesses. There are some global cyclical pressures that need to be in play. But we think generally that trading that market tactically has its challenges, but from a longer term perspective, it does look, as I said, relatively attractively valued.
Richard, let me ask you about Europe, moving to the continent. We got some fresh wholesale price data out of Germany this morning showing a retreat in wholesale prices, but consumer prices in the country remain very elevated. At the same time, you've got Spain and some of the other Eurozone countries, inflation there under control. This puts the ECB in a really difficult position to try to navigate an inflation environment that looks so different across its different jurisdictions. What do you think comes next for the European inflation story and in turn the ECB?
No, it's a very challenging environment from that perspective. And the ECB has signaled that they will continue to hike rates. Perhaps I'm very mindful of the inflation situation in its largest economy, and that potentially has some knock-on effects for the growth outlook going forward, particularly perhaps in some of the peripheral economies. But it's clearly that dispersion of inflation is clearly a relevant challenge for the ECB.
Richard, we were just talking to a guest minutes before, saying that this is not a bear market, that you do have some breadth here, that this does look like a bull market. What do you think? How would you characterize the US market that we've been watching closely?
Yeah, so a lot's been made of the fact that a lot of the returns that we've seen have been concentrated in a relatively small number of stocks. Some of the data suggests that doesn't necessarily mean that we should expect market weakness going forward. Look, I think a lot of it will come down to the inflation outlook, whether we continue to see positive prints like we have this week, whether we continue to see From a tech perspective, some of the hopes and dreams that are now being built into AI actually come to fruition in terms of demand. But you know, there are you know a broad range of exposures there. Some of which will face challenges. You mentioned the outlook for financials earlier on. We'll be paying a lot of attention to the provisioning and to the loan impairments that we see in the coming quarters to really understand just how much of a slowdown we're seeing in the US. We talk a lot about the strength of the labor market, but looking at corporates and corporate profitability will obviously be a key driver going forward.
Richard, you put a lot of caveats here around the inflation story, and we've heard that similar tone from the United States in the last 24 hours. A couple of Fed speakers effectively just not really ready to buy into the fact that they can confirm the data has turned. Do you think that is just too conservative a view, that everybody's been hurt by the fact that inflation didn't play ball, they're now super cautious? Is it just too conservative? Are we actually genuinely seeing a change in the inflation cycle?
I think we are. I think if now whether it beats expectations by 0.1% or misses expectations by 0.1%, the market puts a lot of emphasis on that. But clearly the direction of travel is for slower inflation. You see that in the headline numbers. You see it in some of the numbers that underpin it. If you think about PPI in China, you mentioned PPI in Germany. If you look at freight indices that are obviously much lower than they were a year and a half ago. Look at some of the ISM data on prices paid. There are a lot of underlying indicators to support the idea that we're on a different inflation trajectory. The two questions, I guess, that come from that is, when will we level out? Will we come back relatively easily to 2%, or will we actually begin to level out at a higher number? And what does the Fed do then? Clearly, it seems that Fed policymakers have been a little bit burned by how inflation has played out, and so they're a bit on the cautious side. But we are seeing that trend, particularly in the US, move in the right direction.
Richard, thank you very much for joining us today to talk us through the markets. Richard Flax with our CIO at Moneyfarm. We've had numbers